Hello, welcome to session 2. We talked about if you joined us for last session, we looked at introduction to the global financial market. This is where we try to explain what trading is, what it involves, what the assets we trade with are, what trading involves in terms of who we're trading with, because we looked at 3 questions: what is being traded, who we're trading with, when and how to trade, right? But today we will be talking about trading terminologies as a continuation of our basic session. Every different fields have what they call their registers. That means that any field you go to, any professional field you go to, they usually have some common terms that they use in describing things. Within that particular field or within the professionals there, when such term is mentioned, they know how or what it applies to. You understand? And that's what I want to talk about. Trading also has her own register, right? We have different aspects of trading that mean different things that I think that if you're used to them, if you understand what they mean, it makes it very easy for you to grasp the idea of trading or grasp the idea of advanced trading and all that, which we want to talk about. Let's start with the first one. The first one we're talking about today is PIP. PIP, PIP. And PIP is an acronym. It stands for percentage in point. So it stands for percentage in point. It's a standardized unit. Is used to measure a change in currency pair. Now, remember how when we want to talk about change in distance, we use kilometer. When we talk about change in volume, we could use. But for trading, when we're talking about change in the value of an asset, moving from this particular value to another value, one or what we use for measuring the change, especially in a currency pair, is what we refer to as PIP. Okay, now remember, a currency cannot be traded on its own. A currency is traded in pairs, right? A currency is traded in pairs, and that's why when we talk about trading, you will see something like Euro USD, you see something like GBP USD, right? This is trading GBP against the dollar. Now, for a currency pair is usually made up of 2 parts. The first part is one we'll call the base currency, which is the euro, is the base currency. And then we have the USD, which is the quote currency. So the first part is the euro, which is the base currency. The second part is the dollar, which is the quote currency. So the base currency appears first, okay, and then the quote currency. Now, what does it mean? If, for instance, we see this example, Euro USD is equal to 1.13243. What does that mean? Euro USD is equal to 1.13243. What that means is that 1 euro, to get 1 euro, I need $1.13243. So it means that 1 euro can be exchanged for $1.13243. That's just what that's what it means. That is how, so the quote currency, which is the dollar is represented with that value in relation to the euro. You understand? Okay. Okay, so let's move on now. We are talking about PIP here and how it is used to measure change in price, right? Now, look at this price here, 1.13243. You notice that this particular instrument carries 5 digits after the decimal point. So when we talk of 1 pip movement occurs each time the 4th decimal place of price moves by 1. So it happens each time the 4th decimal place of the price move by 1, right? So look at this price, Euro USD equal to 1.13243. What does it tell us? The 4th decimal digit here, the 4th decimal place there is 4. So usually when we're working with currencies or working with PIP, we don't usually regard the last digit, because the last digit signals the point. But we're talking about PIP. When we're looking at PIP, we're calculating PIP, we consider the fourth digit. And so that is why if we're adding 1 pip to this particular price, if we say this price is increasing by 1 pip, we'll be adding that 1 to 4. And that is why plus 1 pip here is giving us 1.13253. Plus 10 pip here means that we are adding 10 to 2 and 4. We're adding 1 to 2, we're adding 0 to 4, ignoring the last digit, which stands for point. So when we are calculating PIP, we are focused from the fourth digit forward. We're not concerned with the last digit, especially when we are working with 5-digit pairs. Working with 5-digit pairs. On some brokers, some charts usually consider 4 digits. For those you do not really want to bother yourself with, listen, you just start, you start from the fourth digit. But understand that when you are adding PIP, subtracting PIP, calculating change of PIP, you're concerned with the fourth digit of the asset. Right now, sometimes you also have JPY pairs. You have JPY pairs, and JPY pairs are usually 3 digits. JPY pairs are usually 3 digits as against normal pairs that are 5 digits. So how do you calculate PIP movement for JPY pairs? You concern yourself with the second digit. You usually ignore the last digit. Okay, so if we're talking about JPY pairs, we concern ourselves with movement from the second digit. So what we have here is USD JPY is equal to 1.132. If I was adding 1 pip to this, I will be adding that 1 pip to 3. So what I will get to be 1.142. Okay, so we have pip and we have point, and they have a relationship. Normally 10 pips, 10 points make 1 pip. 10 points make 1 pip. Okay, 10 points make 1 pip, right? So 100 points make 10 pips. Remember, because we, of course, 10 points make 1 pip. So as price moves from 10 points, once price moves from 9 points into 10, becomes 1 pip. Okay, and then 100 points is giving 10 pips. So yes, these are it. So ask yourself this: how many points are in 27 pips? Supply the answer to yourself. How many points do we have in 27 pips? If we have 10 points in 1 pip, how many points do we have in 27 pips? If your answer was 270 points, correct. But if your answer was not 270 points, then you need to do that maths again, right? Okay, so let's move on from PIP and let's talk about leverage. Leverage is the use of borrowed funds to increase one's trading position beyond what will be available from their cash balance alone. Okay, now when we talk about leverage, we're using borrowed funds to increase your trading. Now, understand that to properly explain leverage, I want you to understand that trading itself is capital intensive, right? Trading is capital intensive. Now, when it comes to trading, especially individuals, because the people involved in trading, when we talk, are the banks, the hedge fund, multinational corporations, you know, and all that. So it could be very heavy. Right now, what brokers do is to provide, because it's often not possible for individuals to provide the needed capital to trade in the market. But brokers provide borrowed funds to be able to help traders, retail traders, trade. And these funds are provided in form of ratio. Okay, these funds are provided in form of ratio. What does that mean? If a trader has $1,000, if a trader has $1,000 and he wants to trade, and the broker provides a ratio, a leverage of 1:100, the broker provides a ratio of 1:100. What does that mean? It means that the $1,000 of this person controls $100,000 in the market. Okay, so your $1,000 can actually control $100,000 in the market, which means that you can use your $1,000 to trade as if you were trading $100,000 because of the loan, the borrowed funds you've gotten from the broker. You understand? So traders use leverage to profit from relatively small price changes, and it's very important. Now, leverage could actually increase your profit or increase your loss. So it's very important that you decide, or it's very important that you're balanced when it comes to your leverage. Okay. Sometimes, for instance, on the MT4, MT5 platform, you get leverage of up to 1 to 500. On the X Trader platform, you can get leverage of up to $1,000. Now, if somebody was trading with $300 and the leverage it got was 1:200, what does that mean? It means that $300 is controlling about $60,000 in the market. Okay, so that is how it works. Okay, so the higher the leverage you're giving, the higher you can trade, the higher the amount and volume you can trade, and that in turn can decide the amount of profit or loss that you can make, right? Good. So that is leverage. Let's talk about margin. Let's talk about margin. What do we mean by margin? Margin is the amount of money you need to put forward. Now, when we say put forward, it does not mean that you're necessarily paying for the trade. It's not a transaction cost, but it is more like a security deposit. Okay, security deposit that the broker holds while your trade is open. So that is the least minimum amount you need in your account to be able to place a particular trade. And the margin depends on the lot size that you're trading with. The margin depends on the volume you're trading with. If to place a 0.01 or Euro USD cost about say about $10. Okay, what that means is that if you don't have up to $10,000 in your account, you will not be able to place a 0.01. What that automatically means is that 0.01 is what is needed. Okay, so the broker would hold that $10 while your trade is running. But at the close of your trade, that $10 is returned to your account along with the profit, which is added to your balance, or the loss, which is deducted from your balance. Okay, now margin trading is very important. It helps you to make very good profit, but it has significant risk, especially when you're trading at a margin that is too high or too risky for your balance. In fact, risk management will tell you that when you're trading, make sure that you're not exposing more than 20% of your account as margin. What does that mean? If you have about $100 and you're trading at a particular point in time, make sure that you don't have a margin of trades that are taking over $20 out of your account, right? That's margin. Now, when you look at margin, it's automatically calculated and assigned. That depends on the broker. Once you execute a trade, you'll be able to see the margin right there at the corner. Okay, now when you have a margin, you're going to have what we call free margin, and free margin will be the difference between your equity and your use margin. Now, your use margin is what it took for you to enter into that trade. The difference between that and your equity is the free margin. So depending on the free margin that you have, that determines if you could enter into more trades. Like you can see, this person has over 500,000 naira balance, right? Currently on a profit of 46,000, right? And because of that, equity is the balance plus or minus the profit. So he has 582,000 naira equity, right? But the margin is 47,000, and so the free margin is this equity minus the margin, showing us that I have a free margin of 489,000, and that means I could place more trades if I want. You understand? And the margin level is the percentage value. So it is just the equity over your margin times 100 over 1. Okay, now quickly, let's talk about what the difference between margin and leverage is. What is the difference between margin and leverage? This is this very simple difference. The lower the leverage you're giving, the higher your margin, because leverage is borrowed funds. Leverage is borrowed funds, right? So the higher the amount of borrowed fund your broker gives you, the lower the amount of your money you need to use to secure a particular trade. The higher the amount of borrowed funds your broker gives you, the lower the amount of your money that you need to secure a particular trade. And that's how it works. So if your broker gives you, margin could be $10 to enter a particular 0.01, maybe on 1:100. 1:100 leverage, the margin to enter that 0.01 trade is $10. Now, if your broker increases your leverage from 1:100 to 1:500, that means that your broker is giving you more funds to hold that trade. And that means that instead of that $10, on a leverage of 1 to 500, your margin will now be about $2. So the higher your leverage, the lower your margin. And because you lower your margin, it means you can trade higher lot size. And that's why we said with a higher leverage, you can risk more of your account to make more profit or loss. So they have a negative correlation, an indirect correlation, whereby the higher the leverage, the lower the margin. The lower the leverage, the higher the margin, right? And then equity, like I talked about, equity is the sum total of your trade at every point in time. It shows you what your account will look like by the time you close all your trades. Okay, when you have a running trade, equity is the sum total of your balance plus or minus your profit or loss. So if your equity at a point in time is higher than your balance, it means that you're in profit. But if your equity is lower than your balance, it means you're in a loss. Okay, and that means you have drawdowns. Okay, and what drawdown is the total negative profit you have running. You've not closed the trade yet, but it's not in profit at the point in time. That is what drawdown is. Okay, so when you go into a trade, first of all, it's very possible that when you go into a trade, your broker takes spread first. And when you place a trade, the first thing you likely see is negative. But as price approaches your position where you enter the market, your negative increase reduces into profit. But that negative is what we call drawdown. Okay, is what we call drawdown. Unrealized profits can be closed at any time, even before it gets to your what? To your target, right? Now, let's quickly talk about bid and ask price. Let's talk about bid and ask price. The ask price is the price on top. When you open your chart, you have two prices. The price on top is your ask price. The price below is your bid price. The ask price is the price you get when you place a buy on an instrument, while the bid price is the price you get when you place a sell on an instrument. What does that mean? Let's use the example of the local money exchangers. If, for instance, they get a dollar from the bank or from CBN, let's say they get the dollar at around 500 naira to $1. When you go there and say you want to buy, they won't tell you it's 500. They'll tell you it's 700. 700 is the ask price. That's the price on top. They have added 200 to get profit. You understand? When you go to them and say you want to sell to them, they'll buy it from you at a lower price than that 500. Or, that's the bid price. You understand? So you have the ask price and the bid price. So ask price is the price on top at which you can buy. When you place a buy on your instrument, it's given to you at your ask price. Now, note something. When you place a trade, the reason why you first get the trade at negative is because the trade is given to you at ask price. You only be in profit when both your ask price and bid price has crossed where you enter the market. When you place a sell in the market, that sell will be given to you at bid price. You only be in profit when your bid price and your ask price has crossed below where you enter the market. Now, when you place a take profit and stop loss, it is the bid price that will close your buy trade and the ask price will close your sell trade at those targets. You understand? So you could actually place it on your demo account and try it out and see how it works. But note that your ask price is above, your bid price is what? Below. That is ask price and bid price. And the difference between the ask price and the bid price is what we call spread, and that is the broker's fee. The difference between the ask price and the bid price is the broker's fee. Just the same way in my former example, the difference between 500 naira to $1 that the exchanger got it from the bank and 700 that is telling you, the difference between that is his spread, which is 200, which is his fee. Right? These are some of the trading terminologies that we expect you to get used to. Okay. Finally, we have bulls and bears. We have bulls and bears. When we talk about bulls and bears, You know, I'm sure we know what a bear is. A bear is an animal that fights, you know. But one important thing, the reason why we use bears and bulls is because of their unique ways of fighting. For the bear, it stands, okay, and tries to fight down his opponent, right? While the bull takes his head down and tries to lift up, right? And that is how the market works. Like a bearish market is a market where prices are coming down, while a bullish market is a market where prices are rising. When you say a bullish market is a market where you expect price to rise. Like what happens when there is rumor of scarcity in fuel and people rush to go and buy fuel, and that increases the price of fuel. That is a bullish market. Okay, but when, let's say, there's rumors of war in a particular place and people begin to sell their properties in that place, and that begins to bring down the price of those properties, that's a bearish market. So simply put, a bullish market, a bear market is one which prices are heading down, and a bullish market is just to describe the conditions in which prices are rising. We have so many other terminologies, but these are basics when it comes to understanding some of these markets. And this will be very important by the time you begin to look into technical and fundamental analysis. When you try to consider where to place your take profit, when you try to consider where you place your stop loss, these terminologies would help you with them. Okay, of course, let's get your feedbacks in the comment section. Our next session will talk about introduction to fundamental analysis, and we'll also look at introduction to technical analysis. Yeah, well, thank you so much for your time. When you've gone through all this, you can now follow up with our advanced classes, but you might need to go through this once or twice or 3 times depending on how long it takes you to understand. I would encourage you to just take your time, go through it, you know, and then practice. Thank you. See you in the next session.